Shortly after you've dug into the awesome benefits of real estate syndications and begun learning how simple it is to generate life-changing passive income, you might start wondering, okay, that's great, but what about taxes? Hi, I'm Mike Deaton with Deaton Equity Partners, and I'm so glad you're watching right now because you're about to totally change your current view of tax day once you see just how easy it is to reap the bonus rewards that come from the tax benefits of real estate syndications. Now, if you're like most Americans, you probably dread tax day. They aren't thought of as very exciting, are they? Well, my goal is that after this video, you're going to look forward to tax day like a 5-year-old waiting for Christmas morning. So when you invest in a real estate syndication, an important thing to know is that every year you will get what's called a Schedule K-1 form to file with your taxes. This form typically comes in the spring, end of March-ish. Basically, a K-1 statement, it reports your income and your losses for a particular real estate investment. One of the biggest benefits that comes with investing in real estate is that you can write off the expenses. And in commercial real estate, which are the types of real estate syndications I've been sharing with you about, you have two main expense type benefits: depreciation and cost segregation. If you own your own home, you're probably familiar with depreciation. It means you can write off the value of the asset over time. And in residential real estate, it's 27.5 years. So when you buy a home, you can write it off little by little on a straight line average every year for 27.5 years. Well, in commercial real estate, the depreciation schedule, it's a little bit longer, 39 years. If you remember, however, we typically don't hold these syndications for 39 years. We only hold for, let's say, 5 or 6 years. Now, if we only took the depreciation for 5 years out of that 39 years, we'd be leaving 34 years worth of depreciation benefits on the table. That's where a couple of magical things called accelerated depreciation and cost segregation come into play. So cost segregation, it means that when we buy a commercial building, we can hire a cost segregation specialist to come out and look around the property. They'll create a report and they'll say, well, that light fixture over there, instead of 39 years, you can write that off in 10 years. These carpets, you can write those off on a schedule of 5 years. And they'll continue itemizing, so on and so forth, so that at the end of that cost segregation study, we have a schedule that allows us to write off all the different pieces of an investment on a much more accelerated timeline. That increases the amount of write-offs or depreciation that we can take up front during those first 5 years. And I won't get into it in this video, but there's another active tax benefit going on right now called bonus depreciation. And it really turbocharges the tax savings that you can claim in the first year. That's a portion of the investment that the sponsors are handling in the background. And you'll see those losses, because ideally your property is really appreciating in value, reflected in your K-1s each spring. Now, while I think one of the coolest parts about investing in syndications is the cash flow distributions I get each quarter, when you actually get your K-1 in the spring, it won't show that you made money. It'll actually show that you lost money because of all these depreciation and cost segregation benefits. So while you're getting returns flowing into your bank account, on paper, it gets reported that you're actually losing money because of depreciation. I know this can be a little confusing, but for tax purposes, it's a really good thing. That means that you are likely not going to have to pay taxes on that cash flow income. Now, as for the rest of the losses over and above any cash flow, because sometimes those losses can be quite substantial, which is a benefit, you'll have to talk to your CPA about how that applies to your unique tax situation and how much of those losses you can actually apply now and in the future, if any, to your ordinary income in any particular year. So I want to make sure you hear this. It's likely that your ongoing cash flow will not be totally tax-free, but tax-deferred. You might not have to pay taxes on it right now, but when the asset is sold at the end of, say, 5 years, there could likely be a large depreciation recapture and you'll have to pay taxes on some of those gains. Again, your CPA is your best friend here, Talk to your CPA about how this will apply to your personal tax situation, because your tax situation and my situation, they're going to be very different. There are also other clever, totally legal ways to keep deferring or even overcome any of those taxes. All in all, that's what you can expect when investing in a real estate syndication. A K1 each spring and paper losses throughout the life cycle of the project. A lot of big financial decisions take place through the process of finding and investing in a syndication investment. If you've invested in a syndication, let me know about any crazy tax benefits you found from the investment. And if you haven't yet invested in a real estate syndication, what's holding you back? I'm looking forward to chat with you in the comments. And if you're interested in learning how investing in real estate syndications can help you achieve financial freedom and live the life you've always wanted, I am personally inviting you to join our passive income investing group today. You'll find the link down below in the description. And in closing, please give this video a thumbs up and make sure you're subscribed to our channel so you'll get notified when we upload more great content. And do you have a friend who needs to hear this? Please share with them. Again, I'm Mike Deaton with Deaton Equity Partners, and I'll see you next time.